Now we're going to talk about the schedule of cost of goods manufactured. So this schedule contains the three costs that end up in our product cost, our manufactured costs, our direct materials, our direct labor, and our manufacturing overhead. So these help us calculate how much material and direct labor was used in production, the overhead applied to production, and what were our total manufacturing costs associated with goods that were finished during this period. So looking at what our total manufacturing costs were, what then ends up in cost of goods sold, and what sits in our finished goods inventory at the end of the month. So we start with our raw materials purchases. This is very similar to the purchases calculation from Principles of Accounting 1. So we start with our beginning inventory, add our purchases, and then subtract our ending materials inventory. That gives us the number of raw materials that were used in production. Those go into our direct materials. We then have our direct labor costs, which we get from our timesheets that we record how many hours that people work times the cost we pay per hour. The third cost is our manufacturing overhead. This is the amount of overhead that we allocate or apply to our goods and services based on that predetermined overhead rate. We add those costs together, and that is our total manufacturing costs for the period. We then divide out those manufacturing costs between work in process inventory, cost of goods sold, and finished goods inventory. So we have our beginning work in process inventory. We add the total manufacturing cost. This gives us our total work in process for the period. We then subtract the ending work in process inventory, and that is our cost of goods manufactured during that period. We take the cost of goods manufactured and we use that to calculate our finished goods inventory. This is, again, we take beginning plus additions minus ending. So remember, we had beginning materials plus raw materials purchases minus ending materials. Beginning work in process inventory plus manufacturing costs minus ending work in process inventory. Now we get to finished goods inventory plus cost of goods manufactured minus ending finished goods inventory equals cost of goods sold. So just remember that beginning plus additions minus ending. And then whether we're doing materials or work in process or finished goods, then it's beginning, work in process or materials or finished goods plus additions minus ending. As we talked about in chapter 2, the difference between the overhead cost applied to our work in process or manufacturing costs and the actual overhead cost then is referred to as underapplied or overapplied. So underapplied overhead happens when the amount that we allocate or apply to jobs during the period using the predetermined overhead rate is less than the actual overhead incurred during the period. Overapplied is the opposite of that. That's when the amount that we allocated or applied is greater than the amount actually incurred. So what do we do with that then? So we have our actual overhead for the year was $650,000. We had 170 direct labor hours and a predetermined overhead rate of $4 per direct labor hour. So the overhead that was applied during the period is 170,000 times 4, or 680,000. Because that's 30,000 higher than our actual overhead, we end up with 30,000 in over-applied overhead for the period. So as we can see here, we had 30,000 of over-applied overhead. So now what do we do? At the end of the accounting period, the overhead account needs to be closed. We need to do something with that $30,000. There are two methods for that. One we talked about in chapter 2. It gets closed to cost of goods sold. So we move it from cost of goods sold from overhead to cost of goods sold. The second method is that we allocate it proportionately across 3 accounts: work in process, finished goods, and cost of goods sold. So we're going to look at first, we closed a cost of goods sold. So we have 30,000 in over applied. So we're going to debit overhead for 30,000 and credit cost of goods sold for 30,000. If we allocate it equally across work in process, finished goods, and cost of goods sold, then we're going to allocate it based on the total amount. So we see that we have ending finished goods inventory of 68,000. Cost of goods sold is 204,000, and work in process inventory. Let's go to the next slide. So we see work in process inventory 68,000, ending finished goods inventory is 204,000, and cost of goods sold is 408,000. So what we do is we add those 3 accounts together and then figure out what proportion of the total each one of them is. So we can see here that the work in process inventory is 10%, finished goods inventory is 30%, and cost of goods sold is 60%. So then we would allocate that $30,000 in over applied overhead. We would take 30,000 times 10% and put that in work in process inventory times 30% to finished goods inventory and 60% to cost of goods inventory. So we see that 3,000 to work in process, 9,000 to finished goods, and 18,000 to cost of goods sold. So the total of $30,000 gets allocated based on our percentage of total to these 3 different accounts. So that journal entry then is a debit to manufacturing overhead and credits to work in process inventory, finished goods inventory, and cost of goods sold. If we had under applied inventory, then this journal entry would be flipped. We would credit overhead instead of debiting it, and we would then put the other amounts into the different accounts. So of course, the proportionate allocation is considered more accurate. It's also more complex to compute. But because we're talking about manufacturing costs that weren't allocated, it makes more sense to allocate them to the 3 different kinds of inventory that we have: inventory and work in process, inventory and finished goods, and our cost of goods sold, rather than just writing it off to cost of goods sold. So what the standard rule is for this is it's a materiality issue. And materiality principle is one of the principles that gets covered really early in Principles of Accounting 1. So it's something that comes up in chapter 1. So this comes down to that materiality principle. So if the amount is material, then we should use the allocation method. If the amount is immaterial, we close it out to cost of goods sold. And so you might say, how do we determine if an amount is material or not? That depends on the business. So if I have a really big business like Amazon, and I do billions of dollars in sales every year, and the difference in under or over applied overhead is $3,000, that's not a material amount to me. However, if I have a small business that I run out of my home and my cost of goods sold or my sales revenues is, $50,000 a year, $3,000 becomes a little bit more material. So it really depends on the business. Each business sets their own threshold, and that's what gets decided. Now, Your homework isn't going to ask you to choose if it's material or not. It's just going to say these are the two different methods and use this one or that one depending on what the problem is. But if you're an accounting major and you take cost as you move up into cost accounting, which is the next level of principles of accounting two, then you would have to decide based on the information of the problem which one of the methods you were supposed to do. So it's just good to know that it's usually a material amount that is decided. A business will just have a threshold and they'll say anything above this amount gets allocated, anything below this amount gets closed out, the cost of goods sold. That is chapter 3.